All right, welcome back, everyone. My name is Kai Jun. So for those who joining for the first time, I'm actually a econs and finance student in my second year. I've been actually investing for about 5 years or so, and I've been doing so through fundamental analysis FA in a sense. Reason why I started this entire webinar series is more or less to share regards on my passion, as well as to share some light regards towards financial literacy. So little disclaimer about myself is I'm not a financial advisor. So if let's say you want to kickstart your financial journey, do your own diligence research, as well as other alternative is you can look for your respective financial advisor or consultant to get an appropriate advice from them as well. So the quote for the day is actually discipline is actually a new freedom lah. So moving on, we'll talk a little bit more about the drama of the world. So as we can tell in the past week itself, those who have actually have certain interest in the market itself actually noticed the volatility of market surrounding two major news, which is actually the resurgence of the COVID situation when the economy reopens, as well as Fed keeping the interest rate at 0.25%, resulting from the uncertainties brewing in the economy, such as the oil and gas industry, global ongoing tensions such as like a trade war, the riots that's ongoing, as well as the rising unemployment. Back at home, Singapore unemployment is actually at its 10 years high, which is more or less expected since the last major crash was back in 08-09. However, this might actually prove a challenge for our government itself in terms of when they want to implement new policies, as some job might not be actually returning post-COVID situation. Okay, moving on to the topic of the day is actually what I want to talk about is investing into equities is essentially like buying a piece of a business. In other words, being an owner of a company. Obviously, this does not mean that, you can actually demand free data plan if you buy into Singtel stocks or Singtel companies, for example. So for stocks itself, this is like a general overview. For stocks, actually split out into four, I would say, categories. First one will be BlueChip, which is more of like a large company that are pretty much stable. And I'll talk a bit more about them in a bit. Second one will be Green Chip. Green chip companies tend to revolve around within the green industry, something to do with the eco-friendliness and stuff like that. Red chip has to do with companies. It has to do with Chinese company in a sense, companies from China . Whereas for purple comprises of companies that is categorized under red and blue itself. So companies like Alibaba, Tencent Holdings, they're all categorized under purple chip. So if you have any question, just feel free to indicate within the chat, and we'll get back to it at the end. So for trust itself, it might seem confusing at first, as they could, pose as REITs, real estate investment trust, as the terms itself are not regulated, but the securities are regulated. The terms itself is not regulated by the authorities, so it's good to understand, to have a simple understanding about them. So looking into them more specifically, REITs itself, real estate investment trust, in most cases is a company operates based on income producing real estate. Stapled securities is actually a financial instrument consisting of two or more securities bound together so as under one security. So one example would be Escort, where their recent merger was between Escort Hospitality and Ascenders Hospitality, which resulted to Escort Residential Trust. Lastly, business trust itself is actually set up when an asset or the property of a particular business is actually being entrusted to a trustee, and from there on, the trustee will manage the daily operations of the particular business. Lastly, for funds itself, there's actually more than this. There's like hedge fund and private equity funds and stuff like that. But I'll talk about these three main funds that you do get to see very often. Index funds itself is actually funds that track the financial market, such as STI, which track the top 30 company of Singapore within Singapore. And for S&P, they actually track the top 500 companies in the United States. So if the market is doing well, we will tend to see an uptrend within the indexes, within the respective indexes. ETF itself is considered exchange traded funds. They are traded like stocks itself, which they track the indexes, which I'll show you the difference in a bit . For mutual funds itself, they are compared to ETFs, they are more actively managed with fund managers trying to beat the market essentially. So additionally, aside from all this general overview, one thing I want to share with you guys is that as an investor, it's always good to invest into something that you actually understand, despite being said so you have to identify the difference between two major perspectives: the consumer point of view as well as the investor point of view. Simply, I think one good example is if you look into SIA. SIA is a great company from a consumer point of view. They do offer great services and to ensure your travel experience is top notch kind of thing of certain quality. Whereas for investor point of view, we might have to look deeper into the company, understand their current financial situation. Whether is it optimistic or less optimistic, we really have to find out ourselves and determine whether is it a good investment for you, based on your current goal and your expectation of the particular company. So diving into BlueChip itself, BlueChip company, they tends to have a national reputation. That's the first foremost, for their quality and their stability, including of their profitability as well. So most of the company that you see out there are probably a BlueChip company unless they are private. What I mean by that is, for example, if you see like DBS, Singtel, SBS, all these companies that I just mentioned earlier, they are all actually considered under BlueChip. However, being said so, there is also other factor to consider, such as being a very mature company. It's not exactly bad, but for some investor, when they look into a growth company, they will, I won't say avoid, but they will refrain from looking into blue chip as well. But that being said, so there is of course young blue chip company out there. So why I say so is because in terms of growth potential wise, comparatively to a new company is generally lower. So for example, a $1 billion company is unlikely for them, or it's very difficult for them to generate another $1 billion. But for a company is generating 100 million revenue, it's very easy for them to generate the next 100 million in a subsequent year. Secondly, doesn't mean that a blue chip company will be immune to the particular market cycle. However, they will of course tend to be able to survive the current event in the event of crisis strike. So they will be able to perform, not perform well, but perform and potentially ride through the particular disruption. So given said so, the probability is obviously low, but it's not zero. And all in all, of them failing is just a lower probability. That's about it. So lastly, before we invest into any particular company, including blue chip itself, we have to actually consider what are the other factors contributing to major disruption. So one example or a few examples I'll give you guys is, for example, Coca-Cola. We understand that their branding is immensely strong, coupled with the irreplaceable product within the soft drink business. It's very unlikely, any form of disruption is able to change their particular business. However, looking into SPH, which is Singapore Press Holding, we're actually able to see how advancement in technology, shift people's habits, and they're reliant on newspaper for their source of news. So moving on to real estate, which is REITs. It's actually an investment instrument which actually owns a portfolio of income-producing real estates. There are many there are many types of REITs out there, such as like healthcare, commercial, hospitality, industrial, or even retail. So the characteristic of a REIT is that it must distribute 90% of their particular income to shareholders in form of dividend, which means we can actually view this as an income stock itself. Secondly, for every REIT, they has their own particular sponsor, and it's a good indicator regarding the outlook of the REIT if they do have a good sponsor. So for example, CapitaLand has Temasek Holding as their sponsor. In other words, like they have Temasek as their backing. Lastly, for Singapore REIT itself, they had to abide to the gearing ratio set by MAS. Pre-COVID situation, it was at 45%. However, due to the current situation, they have actually increased the ceiling to 50%, which actually allow individual REITs to have more room for that. However, despite that, we have to also understand there is other factors to consider, such as the ever-changing environment, which what we are experiencing currently. One good example would be, commercial REITs regarding offices, where tenants might not see the need in terms of having a physical office space when they could actually permit their own staff to actually work from home. Secondly, due to their need to pay out a large portion of their earnings, there isn't, I would say, much funds used for expansion. Thus, growth won't be as desirable compared to stocks from other industries itself. Lastly, REITs are generally highly leveraged due to their capital-intensive assets. So before you actually invest into them, there is, I think, a few things we can look into after understanding them. So if you want to look into them and invest into them, you have to understand firstly, do identify their distribution track record in terms of their stability in their dividend dividend distribution, like their past history, their track record. How are they faring actually in a sense? Second would be their low gearing ratios, which is essentially debt to assets ratio lah. You want to look at it like less than 40%, which is what I'm actually, it's like a criteria for me when I'm looking into REITs. So actually this reason why I say less than 40% is because this actually allows them to have I would say a larger margin headroom for debt in the event, crises such as what we are facing now strikes lah. Lastly would be their attractive valuation. That being said, and being known that they are actually an income instrument, we should actually look for REITs, with around 5 to 6% yield or more, given the risk that we're undertaking as an investor lah. However, all these are actually what works for me. So do your own, research and your own findings of your own portfolio goals. Then fine tune, I would say, the information, see which of the particular company with the necessary, business cater to your own goals. So the last one will be exchange traded funds. ETFs under funds itself is actually a basket of stocks. So the good thing about ETF is that actually allows you to own multiple companies by just buying the fund itself. So for example, owning STI ETF, which I'll share with you in a bit, actually allows you to own 25 of SG top performing companies, which leads to a lower average cost comparatively to buying a respective company individually lah. So one very good example is I'll give you now. So like I mentioned earlier, with index fund is actually S&P 500, which is at 3.1k points today. Whereas for STI is at 2.6k points. Whereas for ETF exchange traded fund, it's actually for like our STI, I'll say our Spider STI ES3 itself, they actually traded in the market. So current price is at $2.72 today. So that's the slightly difference between an exchange traded fund and an index fund itself. So y'all can find all this information on Yahoo and Finance. Okay, so back to the topic itself. With that being said, there is of course like pros and cons. So the downside with regards to ETF is a tracking error. In other words, the lag. However, this wouldn't be too much of a difference. So it should be the least of a concern. However, it should still be a factor in terms of understanding ETFs itself. So what I want you to note is or pay more attention towards is the portfolio inflexibility as well as the management fees involved. These are the two things that I want you guys to take note. Reason why I'm saying that is because buying the respective funds itself doesn't allow you to fully control the weightage of the portfolio in particular. So you do not necessarily have the ability to choose which company you want to allocate your funds more or which company you want to allocate your funds lesser, in a sense. And investing into funds also means that we have to pay for management fees as well as on top of the brokerage fee itself. So what this essentially means that it actually is eating into your profit itself. So these are the two reasons I would say why some retail investors actually prefer to invest into specific stocks themselves instead of a fund. So after understanding equities as a whole, we also want to identify our own personal, I would say, risk appetite in a sense. For conventional way, people always say, high risk, high reward, or high risk, high return kind of thing. However, there's this book that I came across, which is Intelligent Investor by Benjamin Graham, which is Warren Buffett mentor. What he shared was with regards to the substantial amount of knowledge that you accumulate actually reduce your risk and increase your return at the same time. So one very good analogy I like to share with my friends is that if let's say you know how to swim, jumping in the water is not risky at all. But if let's say you don't have the skill set to swim and everything, jumping in the water is pretty risky. As you have the probability of you drowning is pretty high. And then of course there is the systematic risk whereby if let's say you jump into the sea, there's the chance of wave and everything kind of thing. That's something that you can't control. So yeah. So after understanding your risk and everything, these are the few terminologies that you will come across very often. So I'll be covering a few terms. You'll be I would say using it in terms of identifying a company. So of course, aside from these ratios, it's also important to understand the numbers behind them lah. So don't just like get the numbers of their own face value lah. So additionally, it's also important, to know that certain ratios of a particular stock is more accurate if you're comparing within their own sector or industry. So try not to compare companies in a cross-sector manner. So price to earning ratio, to understand it, is actually, for example, if the P ratio is at 10, what it means by for every $10 you invest into the company, it yields $1 in returns. So moving on, price to book ratio is actually the determination of a company worth after liquidation. As for interest coverage, it's actually the ability to pay their interest expenses on their outstanding debt. So moving on to percentile, aside from ratios itself, dividend yield is actually the dividend per share distributed divided by the share price itself. So that's how we obtain 5%, 6%, for example. Return on equity is actually the management ability to generate income from the available equities. Whereas for return on assets itself is the profitability with relative to its assets. So aside from these few mentioned, you will come across many other different ratios or other percentiles such as current ratio, quick ratio, gearing, debt to equity, payout ratio, gross margin, return on investment, and return on invested capital. So with that being said, I will show you a brief example of how we can use this ratio to screen through stocks. So one of the tools that I actually use is SJAC Stock Screener. You're able to choose any particular sector that you have interest in. So let's assume that I have no specific sector that I'm looking into. But I would like a company that can yield, let's say, as high as 227. But it's unlikely this company will be a great company because it's not sustainable to pay out such a high dividend yield. The following will be P ratio. I try to keep it at 25, regardless of whichever sector. But of course, we have to understand the particular sector and their average itself. So like I mentioned, don't take the ratio, the value of the ratio or face value. The following will be price to book. I tend to want to look it at, at least, 1.6. So we can just adjust here. Return equity, minimally, I want it to be at least 10%. So I'll shift it up to 10. Debt to equity, the lower the better, but due to certain industry having really high debt to equity due to their assets and liability and stuff like that, I'll shift it up to maybe 140. So you're able to play around with all these, but don't get too anal about the input, because whatever you enter here might actually, I would say, more or less, you might actually miss out great companies as the market situation is ever changing. So don't get too anal about it. This should just be on your criteria, not your, I would say, not your must do to follow checklist kind of thing. So from here, we are able to see actually DBS fall under the category. Then we are able to see few companies that actually REITs Global, Great Eastern, UOB Bank, Valuetronics. So we actually can look into these various companies. So yeah. So moving back, also the summary, like at the end of the day, what you can take away from this whole sharing session is actually what you want to identify is companies with good growth potential. In the sense that they do have a competitive advantage, they have an economic mode, whereby barriers to entry within the particular industry is pretty high, so they don't have to compete. Therefore, they can always keep their high profit margin. The second thing, of course, we want a company that has high capital appreciation. That means like in the long run, the stock price will of course increase in value. At the same time, they do generate, I would say, a source of income as dividend to the investors. So it is something that we can look into. Last but not least, regarding risk itself, which is something that people are very concerned about, it's with adequate research, we are actually able to yield a higher return. At the same time, reduce a margin of risk itself. So without further ado, I'd like to actually conclude the particular sharing session. This is my IG and my YouTube channel. Y'all can check it out. I have recently uploaded the past webinar that actually took place in the month of April itself. If you like to research more, you can actually, based on my reference, do a screenshot or something, then do your own research and everything. You can read up from all the references that I've actually input here. The QR code, once scanned, you are able to join the Telegram group, which I have actually have. So yeah, if you all got questions, we can do a little Q&A now. Yeah. Okay, actually, I'll just answer. Okay, we got our first question is how do we decide the PE and PB ratio? With that, I would say you really have to depend on the particular industry regarding their P and P ratio because every industry have a different PE average. So yeah. So I hope I answer your question. The second question is, do the numbers range differently from different sector and industry? The answer is yes. I'll show you a good example in regards to within the banking industry. So for example, if you look into DBS, then the following one we can look into REITs. Okay, from here, once you scroll down within this website, this Share Investor website, by the way, we are able to identify that actually, the banking sector, their average P ratio is about 12.2. So we are able to see DBS basing on the ratio itself, we are able to identify that they are undervalued, but whether they are good investment or not, you must do more research on them to identify whether you want to put your money into them as well. Looking into Escort REIT itself, which is real estate investment trust, mainly in the hospitality industry, you are able to see that actually their P ratio on average is about 16, which is slightly higher comparatively to banking and finance industry. So that's one of the few ways you can consider. Yeah. Okay, so the other question is how do you purchase a high price to book ratio stock? Okay, so I would say depending on the company. For example, if we see this company having a high, I would say their PB ratio fluctuates around lesser than 1, which shows that they are actually slightly either fair value or undervalue. But obviously there are companies that is way, I would say actually depends on the company. So let me have a look. If I remember correctly, I think Tesla has a very high PB. So if you actually look into Tesla, basing on their book value is actually $19, but their share price is $982. So we are able to see that the price to book ratio is way higher, way off the chart lah. So if you're asking me if Tesla is a good investment, my answer is yes. But that's of course in my own opinion. But there is no right or wrong in terms of the ratio, but a ratio should be just an indicator to tell you what is the financial condition of the particular business that you're looking into. So yeah, hope I answer your question. Is Netlink Trust a blue chip company? No, Netlink Trust is not a blue chip company yet. It's not a blue chip company yet. But I believe it will one day, given the current standing of where they are in the particular market. But this is just my opinion. So yeah. If not, I would actually like to, thank you guys for the time. If let's say in the meantime, you all have any questions that you guys think about offhand kind of thing, feel free to, check me up through Instagram. Or if not, those who have my number, y'all can just PM me directly. We can do a further discussion or we can actually talk within a Telegram group itself. So I'd like to thank you guys for your time. For those who are interested with regards to next week webinar, we shall be touching a little bit more about sector research. Then from there on, we can talk about how do we actually, determine companies within a particular sector and how are they faring in a sense. So yeah, thank you for your time. I'll see you guys next week. Bye-bye. Okay.